Welcome to the Banking with Life podcast. This is our Q&A series where I answer your questions regarding the infinite banking concept, becoming your own banker. Let's get started. This is a question on episode 134, Mike Rivas. The reflections, identifying the noise, and lifting the fog. So Mike Rivas and I have done 4 episodes, really two-part episodes. So this is in the second series and the second part of the second series, episode number 134. Ginger asks, is Mr. Rivas willing to share or show his spreadsheet of reality? I would love it. Ginger, I don't know. It's a conversation I'll have with Mr. Rivas, and I assure you, you would love it. So I know it's kind of a carrot out there, and I'm not directly answering your question, but we'll see if we can make that happen and figure out how to make that happen that's beneficial. My concern is, putting things out into the big wide world. When you get into specifics, the listener, so not all, but some listeners may tend to think that this is the only way you do it, or you have to have this tool or that tool to, practice the infinite banking concept. And so that's the only concern I have. And then it's that man's personal work, right? That's his baby that he built from the ground up, and he did it for himself. And he didn't really, to my knowledge, build it to help other people or to educate other people. But he's a very giving individual. So we'll have that conversation. And thanks for listening. In this question, Dale asks, additional capital comes from PUAs and interest growth. Nothing more, nothing less, right? This is a question on banking within business cycles, pretty recent, episode 135. And additional capital comes from PUAs and the interest growth, or the guaranteed increase in cash value of the base whole life policy. But nothing more, nothing less, right? No, we've left out the dividends, right? In which we just can't jump over the dividend, right? Even though it's a non-guaranteed element of the contract, because it's a mutual company, the policy owner is an owner of the company, mutual, right? So when they participate, the insurance company and the policies participate, that just means a policy owner gets to participate in the financial experience of the life insurance company, and that is done through the dividend, right? So if a company has a successful financial experience in a given year, they pay dividends, and that is also additional capital to the policy, and it's extremely powerful over time, right? Because the dividend, correctly structured, should be paid into the paid up additions. Right, so it buys additional paid up death benefit, and it goes just dang near straight to cash in year one. All right. Every company has a cost to the PUA rider. When you pay a premium to the PUA, there's a cost to that. That cost is not the same when a dividend is paid into the PUA. But when the dividend is paid in there, like I said, it buys additional death benefit. It goes to cash value. But it also increases the dividends in that year and every year into the future, which is very powerful over time. It's extremely powerful. So let's don't leave the dividend out. That's important. But thanks for listening, and thank you for the question. And here's a question. Okay, so I'll ask a question. And I appreciate the questions, right? It gives me the opportunity to share, and gives me the opportunity to have things to talk about that are relevant and important to you. Because if you have a question that's important to you, it's probably important to many hundreds of others that don't necessarily get around to asking the question, or getting around to asking a question. So your questions are important and they're appreciated. Okay. I'll be paying my third premium on my first life insurance policy this July. I'm starting to have some cash value that might be useful to use. I've gotten a couple of my adult kids to buy their own policies. So far, we are all living in silos with these policies. How do we implement the concept of a family bank? And I got a very good question. I have a few comments on that. You're in the third year. You have absolutely you should have created cash values that you can use. There's little cash value in whole life insurance in the first year, basically slim to none. In the second year, there's more cash value. Then in the third and the fourth year and beyond, there's greater and greater increases in the cash value. So if you're at the end of year 2, at the beginning of year 3, with a properly structured policy, you're going to have substantial cash values, based in relationship to your premium. And let me say that there's a very common thought process that, once I start paying a premium, until I actually use that money collaterally through loans to go do something, then I'm not really doing anything. And I'm telling you, that's not true. You must have capital, right, to take advantage of an opportunity. So it is okay if there's not a clear opportunity presenting itself, is to focus on building that capital, paying the premium. So you're doing it. And if you have already gotten your adult kids to purchase policies, you're laying the foundation of a quote unquote family bank. So, my good job, and my encouragement is to pour it on, right? The opportunities will present themselves. We don't have to go out and look for things to finance, right? We're all financing everything that we purchase anyway. And I'm not talking about running your grocery bill through your life insurance policy, right? And if you're not financing, anything of significance, then focus on premium. The cash value is a derivative of the premium. So that's the solution. The premium is the solution. The problem is the problem. So I want to encourage you. Good job. You're doing it. So keep doing it. Thanks for the question. Okay, in this question, Bobby asked, I want to do this banking system before I get too old. I don't make enough money though. And this is a comment on a video, Infinite Banking Case Study. Well, listen, Bobby, it takes capital to create a banking system. So a couple of encouragements here. Change your cash flows or change your expenses or change both. Do what you can do. And I don't care how old you are. You have to start where you're at. Just had a lovely couple in yesterday that recorded an episode. Jerry and Becky, and they didn't start until they were in their 60s. And they have a fabulous story. I can't wait for you to hear it and listen to it. So, change your circumstances to the extent in which you can. Create more income or reduce your expenses. Create that difference that you can apply to a banking system, right? I don't know how old you are, but I don't believe anyone's too old to start. If you're 99 years of age and you're uninsurable, or 90 or 89 or whatever the case may be, maybe you have children or grandchildren or great-grandchildren. So if you don't do something, who will, right? If you don't change the trajectory of your family, who will? For the positive, right? So nothing but encouragement for you, Bobby. Keep listening and keep reading, keep educating yourself, and start where you can, okay? Whether it's on your life or someone else's life that you have an insurable interest in. In this question, sometimes the print's smaller than others, right? James, hi, my name is Young. I've been a listener to your podcast for some time now. Thank you. And I want to reach out with a question that I thought might be helpful to your listening audience. Since developing a system of multiple policies is the goal, is it important long-term to max out your death benefit early on by ensuring, since developing a system of multiple policies is a goal, is it important long-term to max out your death benefit early on by insuring up to your entire human life value as early as possible? in parentheses, even if you can only comfortably afford the base premiums for now and not max out the PUAs right away. Or, in parentheses, or would you recommend only opening up a new policy after you fully maxed out your PUAs on each existing policy? That's a very good question, Young, and I appreciate you answering that. And a couple of things. The listener who owns a quote unquote banking policy, an infinite banking concept style policy, you should know the limitations of your PUA and the requirements of that. Some companies require PUA to be paid, on the anniversary date. Some, are scheduled PUA premiums that must be paid, and some are unscheduled. And if you don't max out your PUA, you're going to limit what you can pay into a PUA in future years. All of the companies are different, even though they're similar, they're different. So you should know how your PUA works on your policies. All right. And then there's a couple of questions here. So should you max out the PUA, right, to take advantage of your human life value or your human economic value? And let me speak to the human economic value. And it kind of, mentioned it from time to time over the years. We're all limited on how much death benefit we can have in force from all sources. And generally with the human economic value, it's your age and your income or your net worth. So if I'm 50 and I earn $100,000, maybe I can only purchase 20 times my income in total face amount. Okay. So if I earn $100,000 at age 50, I'm only going to be able to have $2 million in force from all sources, excluding group term, including the group military. So if I have a term and a whole life or whatever it is I have other than the group coverages, the totality of those policies adds to my limit of insurability. Okay. So your PUAs are different. You should know your PUAs. Human economic value or human life value is a factor based on income and age or assets. Maybe I don't have an income, but I'm worth $5 million. Then I can have 1 times my net worth in total face amount. So those are the two basic fundamental limitations that the underwriters use to not be overinsured, quote unquote, or to be properly insured. Right. So the underwriter has a whole checklist of that they have to go by. Right. Nobody can be overinsured. You hear that casually thrown around. Oh, I'm worth more dead than alive. Well, you can change that, okay? Or I'm overinsured. It is literally not possible to be overinsured, because in my example, if I'm 50, have $100,000 in income, and I have $2.5 million in death benefit because I bought the proper type of insurance that has a continuing increasing death benefit, then I'm not going to be able to go get more coverage on my own life because I'm considered fully insured. Okay. And now, if I'm young, right, and I am, but if I'm young and I don't have the premium dollars, I don't have the ability to pay, these high premium and high cash value, it's completely financially sound to be properly insured, especially if you're a young person with a family. The infinite banking world sometimes diminishes the death benefit to like no value. And that's not correct. The death benefit has an absolute value in more than one sense. So my encouragement is for everyone to be properly insured. But look, if you have obligations, and we all have obligations, and a lot of times when we're young and a young family, we're underinsured, right? So you should address that first, my opinion. And then you should focus on capital accumulation with cash value. And you can really do both at the same time. I may go buy the best banking policy that I can wrap my mind around and not stress myself and be able to pay the premium and be able to pay the PUA premium without the PUA limitations, falling away because I wasn't able to pay a PUA premium. So it's properly built for me, a banking policy. It's within my ability, and maybe there's some room for growth. I can buy convertible term that is separate from that banking policy to ensure my insurability, to be insured up to my human life value. Now I've done several things. Number one, I'm properly insured, right? Proper planning, retirement planning, financial planning. It's prudent, right? But I don't have the premium dollars to fund those with the real high PUAs. I can't do both, be properly insured and start, banking policies. So then that takes the risk off of you of not being able to pay a PUA premium, therefore that rider falling off or being greatly limited on your banking type policy. Okay. And there's more work to come on this, but, with the right type of term insurance with the right company. What do you mean by that? That's convertible, right? Either fully or partially. I may have, let's say that $2 million is my insurability. I have $1 million banking policy, death benefit. It's building the capital and cash value. It's correct for me, and I'm learning how to use it, and I'm using it. But I didn't have the premium, or I couldn't wrap my mind around buying enough or paying a high enough premium to get a $2 million death benefit. Maybe I can buy a separate standalone $1 million term policy, and then I can convert that over time, fully or partially, as my ability to pay premium comes about. Okay. So a little bit on human economic value, which is when you think about that, I've got some guy, or some individual 500 miles away in their books. And I love all the underwriters. Okay. They're all overworked. I'm not disparaging them, but it's just the idea that somebody can value my life. I mean, really? But that's the world we live in with life insurance. Okay. So if it's a long-term, if I don't have the ability to pay a PUA premium, next year or 2 years from now, but it's going to change and I'll be able to pay a PUA premium in the second or third year into the future. If your policy is built and has the characteristics in the product that has that flexibility, that's fine. If you're going to wait, 5, 6, or 7 or 10 years before you have the ability to pay a PUA premium, it is better to buy a standalone term that's convertible. Every case is different, but you should, and we all should be working with, competent, knowledgeable financial advisors, life insurance agents, the infinite banking concept, NNI practitioners. They should know these things. Whomever you're working with should know these things. But thanks. That really was a good question, Young, and I appreciate you asking that. Thank you for listening. If you have a question that you would like answered, email me at james@bankingwithlife.com. Thank you for listening. Have a great day, and we'll see you next time.